Hello! Let me tell you a short story from when I was just starting out. Imagine me as a complete beginner in trading. I had bought a book from a supermarket and thought, yes, I'm going to learn technical analysis. So I sat down at my computer, opened the chart, and yes, I had already bought something. I didn't know much, but I was excited to invest right away. Everything looked great on the screen. There was a beautiful uptrend. Candles going up one after another. And I thought, yes, this is definitely an uptrend. I had this nice vision of making profit, and then suddenly price broke the line. It dropped fast. In just a blink, everything changed. That's when the frustration hit me, disappointment, and the big question, why? Now I know. Back then, I was only looking at a tiny piece of the chart. Back then, I had no idea what time frames were. I didn't understand that you could look at price from different perspectives, and that's exactly why we're going to talk about it today. So let's talk about what these time frames actually are. First of all, what are they called? Intervals, time frames, perspective, these are the most common terms we use. And it's simply about how much price action, how much time, is shown by a single candle. On a D1 chart, one candle represents 1 day. On H4, it's 4 hours, and on M15, 15 minutes. Well, that sounds serious, but if we take a more fun approach, we can imagine a fridge. We're looking really closely at the top shelf. Maybe there's a piece of butter, some ham. That's a low time frame. We're peeking at just one small shelf. And then we take a few steps back and look at the whole kitchen. And now we see that someone ate our chocolate. That's a pretty important piece of information, both for us and for the person who did it. And it's something we didn't notice on the lower time frame. And it probably goes without saying that such a situation can have very tangible consequences. And it's the same with the chart. On one time frame, the market looks overbought. We look at it and think there's no more room for it to go higher. So we assume it must drop now, that this is the golden moment. We start entering a position. Then we switch to another time frame, and that's where the trend is just beginning. Another very important point is that the higher time frame is the dominant one. So when something happens there, it can completely wipe out the significance of our smaller time frame. It simply stops mattering, even if it's already overbought or oversold. It becomes irrelevant when a reversal begins on the higher time frame. Of course, I went through the same thing. I used to wonder how it was possible that everything seemed to be the opposite. But over time, calmly and without pressure, I began to understand. And you'll understand it too. It just comes naturally. It's a matter of getting used to it and developing a feel for it. The key, I think, is to switch to 2 higher time frames and see where we actually are. That's something I always repeat. It helps clear up some of the doubts. Using this small fragment of a trend that we have on the chart, which we'll be working with in a moment, it's worth looking at the whole story from the perspective of fractality, meaning that within a larger trend, like the one we're viewing now, a smaller trend is nested, and within that smaller trend is an even smaller one, and an even smaller one after that, and so on. That's exactly what timeframes are for, to allow us to zoom in where we need to and see what's going on within a smaller move. You can compare it to an onion, layer by layer, a trend within a trend, a move within a move, and another move within that move. For example, on the daily D1 chart, you might have a beautiful uptrend, while on the hourly H1, a downward correction is unfolding. And on the 5-minute M5 chart, you might again see an uptrend inside that correction. This is fractality. It's like a puzzle where small parts build larger structures. If you don't know which layer you're in, it's very easy to get lost. You start trading the correction, thinking it's the main move, which is a very common mistake among beginners. All right, let's move on to the example we've got here on the screen. I'll quickly show the 15-minute time frame. Up here at the top, we can change between time frames. You can set up whichever ones you like. There's some flexibility with that in the paid versions. So let's say we're on M15, a fast, dynamic time frame. And that's it for now. We've got our upward trend line. We drew it in, feeling good. Everything looks solid, and suddenly we're dreaming about a shiny Lumbo. But hold on, what if it turns out to be an old Dodge? Well, let's not get ahead of ourselves. Time to check what's happening on a higher time frame. Alright, now we're switching over to the 4-hour time frame. Let's track down our trend line. Yep, here we are. Turns out, it was just a pullback within a larger downtrend, and when we compare the strength of that move to the weakness of the pullback, judging by the angle and depth, it's likely we're heading further down, and that our entire little uptrend didn't really mean much after all. And it turns out that our whole uptrend, our supposed bull run, is right here, in this tiny spot. It's just the second leg of a correction after a very sharp drop. ABC upward, and then we keep heading lower. You can clearly see the strong momentum and steep angle of the initial move. Then comes the weakening, a shallower slope, a loss of momentum, and a pause. And boom, we drop again. So, in the context of the H4 chart, that whole uptrend was basically nothing. Kinda like when you think you're staring at Mount Everest, but it turns out it's just a little hill behind your apartment block. Right arrow in the second example, we'll also take a look at how one move fits inside another, and how it all looks across different timeframes. Here we've got a downward channel on the 4-hour chart, and on this timeframe, we can do all sorts of analysis. But notice something important. Inside these main channels, we also get what we call microchannels, right? So this is the full channel, here's a microchannel, and here's a microchannel. And it can go on like that endlessly. Now, if we zoom out and switch to the daily time frame, here's where we are. That downward channel we were just looking at, it turns out it's just a correction within a much bigger uptrend. And that's exactly how we need to look at it. Here's a really good habit to get into. If you're trading, let's say, on the 1-hour chart like we are here, and we're watching this trend line, thinking about entering a trade, we can already tell this might be a corrective move, probably an ABC pattern. Let's say we want to take action here. The best thing to do is to step 2 timeframes higher. So we switch to the 4-hour chart, and suddenly it all becomes clear. We can see the bigger picture and avoid derailing ourselves. So remember this one simple thing. Jump 2 timeframes higher, check where you are, what's going on, and you might just save yourself from a whole lot of trouble. A good practice is to move 2 timeframes higher to see where we are in the bigger picture. So if you're trading on the 1-hour chart, you can check the 4-hour and the daily. That gives you a nice overview of the context around your setup. Then, to fine-tune your entry, you can drop down to the 15-minute chart and look for a precise entry point. So, it goes from the big picture to the details, not the other way around. On the higher time frame, we define where we are, identify key support and resistance levels, and areas where price could potentially reverse. Then on the lower time frame, we look for signs like being overextended or potential trend reversals. Now, let's do a quick simulation of entering a trade, starting from the higher time frame and going down to the lower one. We're looking at the daily chart, and we can see a downtrend here. Here's what we'll do. We'll mark a few pivot points, the key turning points in the market. To copy a line in TradingView, just click on it, hold down Command and drag. It duplicates automatically. On Windows, you use Control instead. We'll place those lines across all the swing highs we can see here. This is the daily time frame, so we're looking at a big chunk of time here. Let's take a closer look. We've marked these pivot points. These are potential price reaction zones. And if we look over to the right, we can see how price later interacts with them here, here, and here. Alright, good. Now, let's move down to the 4-hour time frame to start. Here's that same area. Let's bring in the RSI as well. Here we have a pivot point, a trend line, and now we're looking at the RSI. We see one strong push into the zone. RSI reacts. It's sitting at a very low level. That gives us a possible signal that a reversal might be coming. In this case, we're seeing a quick rejection off the pivot point. It can look different depending on the context. Sometimes you'll see a fake breakout, sometimes a real breakout with continuation. But here, we get a sharp rejection and a reversal. That single spike on the RSI can be risky because there might be another one coming and price could drop even lower. Now, let's switch to the 1-hour time frame. Take a look on the 1-hour chart. This level looks much better on the RSI. We've got a triple bottom here. 1, 2, 3 touches. That kind of triple confirmation is a much stronger indication than just a single spike. So, once again, on the higher time frame, we get the full picture. We can see the overall landscape, what's happening around us. And here, we're drifting down gently in a corrective move. Today, we might have a chance for a reversal. There's not much to see here, just a single wick that doesn't tell us much, right? But once we move down to the lower time frame, we can clearly see the following. On the lower time frame, we can clearly see a beautiful triple bottom. It looks like there's a strong chance we're breaking away from this floor. We've also got a candlestick formation that strongly suggests a potential trend reversal. And all of that is happening in one spot, a very detailed picture of the situation. At first, all of this might seem difficult and confusing, but trust me, with time, it becomes second nature. In the beginning, I used to draw lines, guess a lot, and often confused a correction with a real trend, which cost me both emotionally and financially. But over time, I started seeing things differently. The most important thing I learned was to always move up to a higher time frame and take a look around to really understand where I am in the bigger picture. That's probably the best habit I developed. Lower time frames like the 1 minute, 5 minute, or 15 minute tend to be very noisy. Price action there is choppy and much harder to read. The 1 minute, 5 minute, and 15 minute timeframes are often very choppy. The price action is just hard to read. But when you move to the higher timeframes, everything feels more structured. There's less noise, fewer wicks, and it's much easier to spot the bigger picture and the overall market structure. That's why I always recommend going 1 or even 2 timeframes higher. It really helps. If you enjoyed this video, feel free to give it a like and subscribe to the channel. And in the comments, tell me what used to confuse you the most when you were starting out. I'd love to read your stories and reply. Thanks so much for being here. I'm rooting for you, and I'll see you in the next episode. You'll find a link below the video to my website and resources. Check out the books and upcoming content. And as always, you're warmly invited to join me in future episodes.